record this session. Okay. All right. Good morning, everybody. Welcome to our monthly commercial meeting. I, you know, as I always said, I always looking forward to the commercial meeting because this is a chance that we all the, commercial agents can get together and share information. And particularly today, you won't be disappointed. We have a very powerful keynote speaker today, and she is from USC, and she has ample of knowledge in real estate development. But before I introduce her, I would like to make a couple of announcements and take care of the housekeeping matters. Okay, first of all, I would like to let you know that our mentor program is in full swing. If anyone want to have a mentor in a commercial real estate, just let me know, and I can hook you up with some very experienced and very good real estate agents in our own company. And I think it's very beneficial to be working as a team, especially for the high-end commercial real estate. And if you can show your strength and knowledge, and that will impress your clients. So if you want anybody to be a mentor or just to have somebody to work with, let me know and I can make the arrangement. Okay. Now, secondly, there is a very nice virtual program in our Coldwell Banker Commercial University, where you can learn the commercial real estate module by module, and then you can go back and at your own time and to review it anytime you want. And each module you can has different topic, and you can learn it at your own pace. And it's an excellent program. I have done a few of those modules, and it's very beneficial. And this program normally you have to pay $2,500 for the set, but since you're the member of this Coldwell Banker Commercial Agents, you can get it free from the CB desk. So you just go to the CBC University and go to under my courses and search for the LIPSEY program, spelled as a LIPSEY program. And then all the modules will pop up, and then you can select each individual one that you want to do. As I said, it's very useful. If you need further information, you can always call me, and I can point you to the right direction. Last but not the least, I'm happy to tell you that officially we are confirmed that we have 25 agents, residential agents who are qualified for residential awards of distinction, and there are 2 agents who are qualified for the commercial awards of distinction. So altogether we have 27 awards this year. Actually, not for this year, but for 2021. So pretty good. Last year we had 22, and this year we have 27. So it's quite a bit of improvement. And as a matter of fact, some of the agents has broken their own record, in 2021. So all in all, 2021 was a very good year for some of the agents, for some of our commercial agents to be particular, and very good for Coldwell Banker George Realty as a whole. So congratulations to those who qualify. You did a very good job, and keep up with the good work. And we are going to have award distribution ceremony in the beginning of May in San Gabriel Country Club, and where we can get together and celebrate. And hopefully that it will be a good event for all of you. And so look up for the date. We haven't set up a particular date yet, but just wait for the announcement. Okay. All right. With that, it's time to introduce our keynote speaker for today. She's a professor from USC, and her name is Mary Lynn Bourne, B-O-O-R-N, spelled the last name. Mary Lynn earned her BA from Princeton University MA degree from UCLA, the Graduate School of Architecture and Urban Planning, and her doctoral degree from the University of Cincinnati College of Design, Art, Architecture, and Planning in the area of regional development. And Marilyn is currently an associate professor at USC's Price College of Public Policy in the real estate department. She began her career in real estate finance and spent the bulk of her career in real estate development. And finally, as a consultant to multiple national firms. And also working with both the traditional and nonprofit real estate sector, Marilyn brings a diverse set of perspectives to practicing and teaching the real estate. So without further ado, let's welcome Professor Mary Lynn Bohn. Take it away.
Hi, everyone. Thank you. So today I will be speaking to you about, it was nice, Peter gave me a very wide open berth to choose my topic. And so originally I was thinking that I was going to be talking about some things going on in the industrial sector. But as I was pulling out more current reports and, really kind of looking at what's going on, the headline really is inflation, right? And rising interest rates. And so while I kept kind of trying to, move the topic back over, I thought, well, let's just dive in. We'll just go straight in and we'll talk about inflation. We'll talk about interest rates and kind of tease out, should we be concerned? Should we not? In terms of our real estate investing, what does this mean? So I do have a little bit more of my professorial hat on today compared to some other public speaking engagements that I do. But I found some really interesting studies regarding kind of risk to real estate investments and how real estate investments perform in inflationary times and in rising interest rate times. And so I thought those would be useful to kind of go through. They're not overly technical and I'll keep it pretty straightforward. They're not, wild academic reports. They were done by industry sides of the research field. So I think you'll find them pretty accessible, but we'll walk through some of this and we'll just kind of set the stage of what's going on right now. What are some of the concerns? And then, as I said, we'll talk about some of these studies and some of the findings from those, and hopefully you'll find that useful. And if we have time, I'll touch base a little bit about just why LA is obviously such a powerful force in industrial and kind of some of the things that are going on, but I don't think we'll have time to go there. So, but anyway, we'll go on. So I'm hoping do I have the ability to share my screen, Caesar? Okay, great. And for this, I'm going to go ahead and keep it in this form because then I can see my slide deck a little bit more easily, if that's all right with you guys. And I can also tell what time it is too. If I get too into if I do the big formal presentation mode, then I kind of lose the ability to see all of you and everything. So, and Caesar, I don't have, let me pull up the chat too. So I have the chat off here to the side too. So if somebody wants to type a question into the chat, you're welcome to. Given that I lecture all the time online, also, I am completely open to people just raising your hand and asking questions too. So we can keep this relatively informal. Again, I started off wanting to talk about industrial, and I'm still happy to touch on that a little bit, but everything just kind of kept coming back to the inflation side. I come at real estate from a bit of a different background. They're teaching from a bit of a different background. As Peter mentioned to you, I used to be a shopping center developer. Back in the day, I worked on a couple projects in Southern California that you might have bumped into before. But I have found that over the years, I've become increasingly fascinated by the industrial side of real estate because It's really just the other side of the coin for retail now. And so much of the sales that used to happen in stores are happening online and then making their way through industrial buildings instead of shopping centers to get back to our houses. So I am fascinated by that. But when you keep looking at the huge increase in activity industrial, it really comes back to the big increases in terms of consumer activity, wages, supply chain challenges, and those are all really tied together with the economy right now, particularly this idea of inflation, supply chain constraints, et cetera. So I'm going to walk through a little bit about what's driving inflation and then some of the expectations of what do we think is going to happen with real estate as a result of that. So again, everyone's talking about inflation. What does this mean for us? The big drivers of inflation right now can kind of be boiled down to three primary areas. So one is the supply chain, and everyone's talking about the supply chain, right? But it's really the constraining of the supply of goods, whether those are finished goods or whether those are raw materials that then need to be used to create a finished product. It's all been tightly constrained. So just one little note, truck capacity right now is down by about 5% compared to pre-pandemic, while retail sales have grown by 16%. That's just one teeny little factoid, but it captures a lot of what's happening, right? The labor shortage is another big one. And so with the labor shortage, we have huge amount of job openings relative to the people that are looking for jobs, the unemployed. And this is really driving up wages. The average I've heard in a couple of reports has been around 5%, but in food services and hospitality, that's gone up to about 15%. So again, that puts upward pressure on prices or, squeezes profitability for many businesses that, again, they want to pass that expense on to customers in the way of rising prices. And then housing shortage, which I'm sure being associated with your firm, you can't help but be very aware of the housing shortage. And in Los Angeles, in our market, we're facing that even more than many markets. So that's, again, these are things that are really pushing this very inflationary environment. Here's a beautiful graphic that just shows how high it is right now. But even just today, I read a report that was saying that now inflation is up over 7%. So again, very high numbers here that we're seeing. And the expectation is that those will continue at least in the near term. Again, this is looking at the actual year-over-year changes. Again, you can see this huge, steep, sharp incline of the inflation that's going on in terms of year-over-year change and the expectation of 3 years ahead. So the expectation is that for the next couple of years, we're going to see the effects of inflation, that this is not going to be, as short-lived as some had hoped. So when we hear about what the Fed is doing, several investment banking firms have come forward and said, why don't they stop right now? But they have been changing their approach towards quantitative easing, meaning that they are not buying these treasuries anymore. So the government was out buying literally billions of dollars of treasuries every month in order to keep the yields high, which keeps rates low. They are inversely associated. And so they've been kind of backing off month to month. So it started back in October and they started to cut back. And the plan is that they will be reducing them to zero in the upcoming month. Now, why they just stopped entirely, I think they're just staying their course and going through a gradual decrease. The other thing that they've said is they're going to rise rates, increase rates. So we're all aware of that and everyone's a little concerned about it, particularly as it relates to real estate. Both the commercial side and the residential side could be greatly impacted by that. And so while the short term, the overnight rates that the Fed sets have been basically at zero. I think you can probably see my cursor on the screen here. They dropped those right with COVID starting and are continuing through. But we see that they're pretty much at the zero line. Let's see, even if Fed increases the fund rate, won't resolve the supply problem, am I right? Steve, are you talking about the supply problem, the current money supply issue?
No, not money supply. I'm talking about the all this kind of delivery, congestion in the port.
Absolutely, yeah. So they're really two separate issues, right? So the Fed stopping that activity, they're really trying to actually slow the economy a little bit, which is unusual for them. But that's kind of the plan, is that by doing that, they will slow the economy, and that they will actually, the rates will go up. And their goal is to have rates go up. They've suppressed rates in order to increase activity. And between that and the money that they put, that they gave to individuals, has actually really ramped things up and probably overstimulated the economy. And so they're trying to pull that back. So you're right. I mean, we're going to see this shortage of goods, shortage of housing that's putting the upward pressure on the real estate prices and so many other prices. We're going to be seeing that for a while. You're exactly right. Yeah.
So the consumer confidence could go down.
It could. And that's something that's a really important point. So as we walk through this, a lot of the discussion around this is saying, hey, real estate should do well in inflation. That's kind of the takeaway. we can cut to the end of the presentation really fast, but generally speaking, real estate does well in inflationary times. We'll talk about why. But the other thing that's interesting is we tend to do well even in higher interest rates. Now I'm talking about commercial real estate. And commercial real estate still tends to have price increases during higher inflationary times. The issue is as long as we don't enter recession. So that's a big one. So, as long as the economy continues to grow, and right now, even with the supply constraints, GDP continues to rise. And so as long as the economy continues to do well, then we will do well in real estate. Now, if we were for some reason to tip into a recessionary phase, which we don't expect, at least not in the current outlook for 2022 or even 2023, then that would change the nature of this. But what we find is that real estate does well in those environments regardless. So again, this is just showing right now. I snapped this 2 days ago, I think it was at 1.99, the 10-year treasury. I just bring that up because I do talk a little bit about the spread between cap rates and treasury bills. And so as treasuries go up, that's going to be something we'll talk about, because it's going to shrink the spread between real estate cap rates, which are real estate returns, and this 10-year treasury, this no risk lending rate. So just something to be thinking of. So again, let's go back to real estate investing for a minute. And I'm going to set the stage, just refreshing us all about what is real estate, commercial real estate, what we're really talking about. And one of the big things is that real estate is really two markets, right? So we talk about the real estate market, and we can talk about it at the physical assets. So the landlords and the renters, right? And they get together in a market equilibrium that is the market rent, right? But the other really important part of the real estate market is the market as financial assets. And this is really what we're talking about with the capital markets, right? So this is looking at the investment side of things with owners and either buyers of actual buildings, and the investors or the lenders that are involved in those transactions. So that's really what we're getting at right now, is this whole idea of what happens to the values of properties and how are they impacted by the capital market side of things. And so we find that these two markets, they don't always run together. So, and that's what this is showing. This is a study that was done that looked at how the physical market, they call it the space market in this study, and how the asset market, which is the capital markets, how they don't always run together. So, you know, kind of mid 90s, early 2000s, we saw a lot of increase in rent and then decrease in the rents in this kind of space market. But on the asset side, when we look at the pricing and the trading of buying and selling of properties, that was really high, kind of during that pre-recession peak, whereas the actual rent side of things were relatively flat. So that's really impacted by how much investors want to be in real estate. And the increase in values here was really coming from lowering of cap rates during that time frame. So we kind of need to understand that there's like two markets that act as one market, but they kind of behave differently sometimes. So again, this is just kind of highlighting that issue of the red is the NOI, net operating income, the rent side of things. And the blue is really driven by cap rates. That's the market price side of things. They tend to run together, but we can see points in time where the market has responded very dramatically. This is looking kind of post-recession and during the recession and then post-recession. The market changes prices quite quickly, and it takes a while for the rents to catch up, right? So this just highlights some of these places where we saw big increases or decreases in the values and not as big a decrease or increase from the income side of things. And so this is kind of tracking the cap rate changes during these same times. And so cap rates can either increase or decrease very quickly depending on this. And that's really because the exchange of properties and the cap rate piece of things can respond much more quickly. But since we have leases in place, our income side doesn't move quite as rapidly, right? We have a lease that's in place for, if it's office, it can be 5 years, right? So you won't see a big change in the net operating income of an office building, especially if it's fully leased, until tenants start to turn over either during the recession or during a high growth period, and then you can kind of surge ahead or you'll fall behind if it's going up or down, right? Whereas the cap rates, a lot of the time investors, just kind of like in the stock market, they trade based on what they think is going to be happening. So right now we're still seeing a lot of compression in cap rate because investors say, I think rents are really going to be growing, right? I think that's going to be constrained in terms of the amount of buildings that are going to be built, new supply coming online. And so we see these cap rates shrinking. And we've seen that consistently over the last couple of years. Whereas the incomes may or may not have been able to keep pace, just the income of a particular building because of the leases that are there. So that's just something to keep in mind when we think about how the market responds, how real estate markets respond to big changes. The other thing I really want to key in on here is that for the, when we think about cap rates and we think about returns on an investment, we're looking at from a couple of different directions. One is the term opportunity cost of capital, which I'm sure many of you are familiar with, but just to bring it to the forefront in our thinking. So what we mean by opportunity cost of capital is, how is real estate comparing to other types of investments, right? So if the stock market's booming and real estate is relatively flat, then how is that looking, right, in relative terms? We want to make sure that real estate is still performing very well from that perspective. The other is this idea of the cost of capital. And we think about the cost of capital, a lot of the time we think of it just with interest rates. And we're all very aware of interest rates right now, right? But it's also about how much the equity investor is expecting to get. So I just have a little math here, this weighted average cost of capital, but it's basically saying, you know, if interest rates are, if your debt is 70% of your cost of capital, and those rates were 3%, and 30% of your project cost, your investment, was from the equity side, and the expected return on that is 8%, you're going to have this blended rate with called weighted average cost of capital of 4.5, right? So when we see the cost of equity decreasing to say 6%, then that weighted average cost of capital goes down considerably to say 3.9%. So we need to remember that the cost of capital is not just the debt, it's the equity too. And what we've seen when we look at cap rates and we think about our returns on real estate, we've seen that actually it's the equity side of things that have been decreasing. The investors tend to be willing to take a little bit lower returns, in part because the debt is cheap, but also because real estate is a really good investment right now relative to the low returns that are available on bonds and all of these other types of investment vehicles that are pretty low risk. So in terms of like low risk, stabilized real estate properties, we're still doing really well compared to a lot of other investment opportunities and investment vehicles. That's just something to keep in mind as we think about what the impact could be on us, that we're not just dependent on the interest side of things, the cost of debt. We're also thinking about what that cost of equity is and what equity investors are willing to accept overall. Okay, so that's just another thing to be mindful of. Again, I touched on this, but this is really looking again at risk-adjusted returns. So if you're looking at a really good quality piece of property, an office building or a really nice industrial property, really nice apartment building that has lots of tenants, et cetera, then we think about that risk. It's really in relation to much lower risk types of opportunities, right? So again, that's just something to be very aware of. And the last piece that I bring up, and I touched on this before, but capital flows and capital capacity. Right now, and in the last several years, we've seen a flood of capital, both international money and also capital from within the United States. There's a lot of capital, a lot of what they call dry powder, which means capital equity that's been set aside for real estate investment, but hasn't yet been invested. And so this wave of capital is out there looking for assets and looking for return. And it keeps going back to US real estate, particularly in markets like Los Angeles, gateway markets, because it's relatively low risk and higher returns than a lot of other low risk investments that are out there. And so when we see this is an interesting report from Real Capital Analytics. They have a lot of really good data, but we can see that this is looking at international investor investments, and there's a huge amount of capital that is out there that has been invested over the recovery from the Great Recession. These numbers kept just going up and up. And we still are at a very high level. Again, apartments, you can see the apartments are the dark orange. So those have been very much the darling of the investment community. But industrial in the light blue has been gaining quite a bit of traction as well, for good reason, as we mentioned before. And so we see this still a huge appetite from international investment to invest in real estate in the United States, with a lot of that coming to the Los Angeles market. It's a market that a lot of international investors are very comfortable with. So that's something else to be meant. Okay. Oh, I'm sorry, Steve. Yes. So when we talk about commercial real estate, we're talking about all of those. So we're talking about office, we're talking about industrial, retail, and multifamily, as long as it's apartments, rental apartments. So when we talk about residential, a lot of the time outside of the commercial side, then we're just talking about for sale housing. So it can be still like condos, or it can be just, single family homes. Okay.
Marilyn, I have a question at this point. Now you mentioned that the cap rate has been diminishing the last few years. I think it's because of the historical low interest rate by the Federal Reserve. But once this year they're going to increase it at least 4 times, and I'm sure that by the end of the year it will be substantially higher. Would that would make a lot of difference in the cap rate. And if the cap rate goes up, that means the price of the real estate go down, you know. So what do you think of that?
So that is a great question. It's exactly the question I want to hear because I'm just about to touch on that.
Okay.
But I will say, I'm going to go back here to my earlier slide really fast here, because what it's important to note that the cap rate in part went down because of interest rates, but not altogether.
Mhm.
So interest rates have something to do with it for sure. But we also see that investors, because there's so much appetite for real estate, that investors have also been willing to take on a little bit lower of a yield on their investment. And not just because debt is so cheap, but also because, again, on a kind of risk-adjusted basis, they have a big demand for real estate, and they're willing to accept a little bit lower returns. So it's both because of the debt is cheap, but also because there's a big appetite on the equity side for investment. Okay.
Yeah, and you're talking, and also you're talking about the risk factor now. Yeah, after during the COVID, they have learned that a lot of things can happen. You know, for example, they cannot collect the rent and they cannot evict the tenants, and you know, there's a lot of hassles owning properties. Especially sometime in commercial real estate. So
absolutely,
that kind of the risk factor has to be taken into account in the assessment of the cap rate too, right?
yes, absolutely. But one of the biggest drivers that we're seeing in terms of cap rate compression, and why even in things like, you know, industrial, I mean, cap rates are so low, right? And in apartments, cap rates are so low, and you think, how could they get any lower, right?
Mm-hmm.
But part of it is because of the low risk, right? And part of it is because the expectation is that rents are going to go up. And so I wish I had like a little chalkboard here, but you know, if you think about kind of value, and we think about how value is determined, it's determined by NOI, net operating income, divided by the cap rate, right? Mm-hmm. So value is two of those things, right? So as cap rates go down, values go up. Mm-hmm. But if the cap rates stay the same, or even if cap rates went up a little bit, as long as NOI is going up by a bigger factor, you can actually still be okay, right? So part of where the investors are getting comfortable and where their underwriting comes into play is because they think, well, my NOI is still going to be growing. So even if my cap rate isn't, my NOI is growing, so my value will still be increasing. Now, is that true? We don't know, but in an inflationary time, we could say, well, yeah, rents do go up. Rents are going up, and they could have the potential to go up quite a bit. And so that offsets some of the issues about the cap rate. So it's a perfect question. And actually my next slide. So if you look here, where we see cap rates compared to US Treasuries, we see that this is looking, I have a longer term view on the next slide that I'll look at, but just generally speaking right now, we see that the price index for commercial properties has been going up a lot since the Great Recession. The recovery has been strong and powerful. And we see that the green part is looking at the cap rate spread. So where, again, this is just looking at a blended cap rate, commercial cap rate, and where the cap rates have been relative to the treasuries. So, you know, very low interest rates, right? They used to be way up here at 5%, and then down even like by 1%, a little bit even lower than 1%, it looks like, right? Starting to pop up a little bit. This took us through 3Q of 2021. But as I mentioned, we kind of see that they're getting closer to 2%, if I could add another bar here. But overall, we see that these are still pretty robust spreads, right? We've seen them get quite narrow at different times. And this shows you a little bit longer of a view. So this is looking from 2005 through 2021. And this is showing where the treasuries have been And then this is looking at the debt spread and then also the equity spread. So if you looked at the debt spread from the standpoint of what a commercial mortgage would be, and then we look at kind of what that equity piece would be, we see again that the equity piece is pretty robust and the debt piece has been pretty robust. So you could have a little bit of shrinking on either or both sides and still have some pretty good returns. Now, again, it's all order of magnitude, but even right now, rates have been so low, right, that even if they went up by a bit more, you've got some movement in here that you've got a little bit to go. So again, this was just looking at some of the projections. This was put together by CoStar. And we can see that they were projecting, some increases here in the Fed funds rate. Probably somewhere in the middle is what they were looking at. So, looks like about, call it 150 basis points to go through. And again, would this impact cap rates? It certainly could, particularly if the spreads got a little bit narrower, but we still have some room in terms of where cap rates are relative to this 10-year treasury rate. And so, the other piece of it will be, do we expect rents to increase, right? And I think overall, most of us think cap rates will go, or that rents will increase. So I'll just kind of, I think actually in the essence of time, I'm going to just show you a couple of quick other little bits here, just to, I'll kind of skim through those reports so that we've got time for questions and to talk about it afterwards. But this was the one from the Black Creek Group that I was mentioning. This was done back in 2017, and it was looking at how commercial properties have performed over the past 5 economic cycles, and looking at how they did during times of rising interest rates versus times of falling interest rates. And what they found was, when they looked at this was over a 40-year average, that overall, the average, obviously real estate did well, but that actually real estate tended to do better during actually rising interest rates. Rather than falling interest rates. And a big reason for this is because of the income side of things. And so what they found is that oftentimes when we have rising interest rates, the Fed or the monetary groups are actually increasing rates because the economy is doing really well. And when we find that we've got lowering interest rates, oftentimes the lowering interest rates are because the government is trying to improve the economy by decreasing the cost of debt, right? As we've seen just recently. And so what we find in this study, what they came out with, is that at the end of the day, the power of those increasing rents and increasing values was greater than the negative impact from rising interest rates during these timeframes. And so I think that's extremely relevant given kind of what's happening today. Again, this is just looking at how the overall incomes, how the overall returns looked. High employment growth and growing GDP were the biggest drivers of real estate returns. So this gets back to the point of, as long as we have high employment and high GDP, right? Rising employment, rising GDP, that would indicate that we should expect that our properties will do well in terms of rising interest rate timeframes. Again, this was looking at correlations in rising interest rates, and inflation tended obviously to be a big driver of value, overall value during those timeframes of rising interest rates. Whereas the returns were substantially less when you were looking at times of falling interest rates. So again, just something interesting to consider, but generally speaking, the Fed is increasing rates because the market's doing well. If the market's doing well, our rents will be going up, right? And we will have increased GDP, increased employment, and those are really the factors that real estate values are based on. And that our returns are going to be benefiting from that, as opposed to this issue of the leverage side of things. As an aside, Peter, I think your point is well taken. The other thing that I would mention, though, that really helps and insulates the environment right now is that there hasn't been too much lending. That there is a little bit more cushion between debt and equity right now. During the Great Recession and other real estate-led recessions, we've seen too much leverage, we've seen too much debt, and when rates increase, there's not enough cushion there. And that hasn't been the case leading up to this current time, where if rates were to go up, I don't know that you would see a big negative effect in terms of like delinquencies and those kinds of things that we have in the past, because again, we've got a little bit more cushion. Okay. So again, yeah.
Marilyn, yeah, you're right that the lending part has some effect on the economy too. The bank has a lot of money to lend, but what the problem is, whether they the borrower qualify or not. That's a problem that a lot of banks has right now. That's why the banking industry is so competitive.
Right.
And so it's not an easy problem,
Yeah. So I probably should leave it open for questions. I'll show you. Would you like me to show you that other quick study about real estate values and inflation?
Yes.
Yeah. Okay. So I'll just flip through here. I had some other pretty slides about GDP is going up. GDP is expected to continue to go up. We see obviously employment is incredibly strong, and we see that there's a shortage of employment. So we're going to see some wage increases, et cetera. So again, these are all the hallmarks that they were talking about, hey, real estate does well during these times as long as employment and GDP are doing well, and they are, right? So GDP is good, employment is good, et cetera. This was looking at multifamily spread to treasuries. But again, there's been quite a lot of cushion there between cap rates and the treasuries. And we see that we are, if anything, at larger than average spreads right now compared to some of the other timeframes in the past. We do have a little bit of room to maneuver. So this was a study that Cushman and Wakefield did. Am I allowed to bring up their name in this? But it's an interesting study that they did, looking again at change in real estate values relative to inflation. And they looked at it relative to, they used GDP as the proxy for economic growth and CPI as the proxy for inflation, right? So those were kind of the two measurements that they did. And then looked at how do real estate values do. And I'll just keep it on this slide because this is the most important one. But basically what they found is that CPI was a bigger indicator than economic growth in terms of, for every 1% increase in CPI, real estate outperformed by about another 0.1. So CPI increases or 1% inflation, real estate actually increases by 1.1%. So we kind of go out ahead of that. Now, again, this is with the exception of hotel, didn't do as well, obviously. And, but as far as kind of the big buckets of office, apartment, industrial, the ones that many of you are going to be concerned about, that was generally the overall trend, is that, real estate tends to do better during inflationary times. Again, they were looking at REITs though as well, and found that REITs did even better. That REITs outperformed just the commercial property indexes, again, in terms of during inflationary times. Those did a bit better even still. So I think I'll leave off at that for now, and we can all kind of chat now because we've got about 10 minutes left. Are there questions, comments?
Ellen, I have a question. You mentioned that the commercial real estate will generally do better during the higher interest rate, right? But I think it's it is during the normal the economy it's that case. But don't you think that nowadays the economy is kind of artificially pumped up by the government by means of subsidizing a lot of the economic sectors like the airline and the hospitality business, so actually we are not having such a good economy. It's kind of elusive.
So Peter, I think you bring up a really good point of how much of this economic growth is kind of embedded in all the stimulus is kind of artificial.
Yeah.
And we could say even some of it just historically has been that way because the interest rates have been kind of artificially suppressed as well, right?
Right.
So I think a big part of this will be, we don't know, is the main answer, right? We don't know how much as the stimulating money that they put into the economy works its way through. Do we have real GDP growth, right? Are we having the consumer spending that's taking place right now? Will that retreat by a lot or not? I would say overall, I would go back to the wages on that. And if wages continue to increase and we continue to have challenges filling the spots, as long as we can find an equilibrium, then I think we will continue to grow. If there are shortages that keep us from being able to grow economically, so GDP is actually stifled because of labor shortages, because we can't find the goods, raw goods, et cetera, for manufacturing, we don't have the purchasing power, then yeah, if we go into recession, all this stuff goes out the window for sure. The other thing that I would put out there, which I hate to end on a question as opposed to an answer, but something that concerns me is we've never had this level of deficit before. And when money is cheap and rates are low, deficit is not as bad, right? But if the interest rates go up, it's something people aren't talking a lot about. But if interest rates go up, our cost of debt goes up. So I think that's another issue that's kind of floating out to the side that no one's really talking about and that no one really knows what the impact is, because this is new territory. As you mentioned, even just with all the stimulus that's happened. So these are all kind of wait and see. But if we can use the past for any guidance, right now, at least we are finding that, as long as these rents continue for us as real estate investors, as long as the rents continue to increase, which they show good signs that they will, particularly in the apartment and the industrial sectors, which relate to increase in housing formation, right? There's a lot of kind of basic things that are causing that. It's not kind of swirling stuff, people getting an extra, dollars or whatever. We're really talking about millennials. We're talking about Gen Z. They're moving into apartments. They're moving into homes. We've had a shortage of new housing. So I think the residential side is pretty strong. And same thing with the industrial side. We still need places to take these goods and move them through, because we have a tectonic shift from stores to people buying in space, right? Buying in the cloud. And so that's still something that we are working our way through, regardless of kind of the rest of the noise in the market. So if those rents continue to increase, then I think that we will still see some strength in those two areas.
Yeah, very good point. Very good point. Very enlightening. Good. Thank you very much.
Absolutely. Any other kind of questions, comments?
Yes, I have one question.
Yeah, Steve.
We are talking about the possibility of the Federal Reserve increase the overnight funds rate. And the consider what you just mentioned about the deficits that we have. And Uncle Sam need to pay the interest on those deficits. So whenever you have a higher interest, that means they need to pay more. So what is the perspective from you? Should I say Uncle Sam or Federal Reserve Board, how to maneuver this kind of situation over?
So yeah, that's exactly one of the issues, right? That people aren't really talking about is this issue about the deficit. And, you know, they have a lot of flexibility, but because, you know, they've been, you know, buying the bonds. But yes, it's you know, rising interest rates is going to make those debt payments higher. And the question is, you know, what does that mean long term? You know, a federal budget's not really like a household budget where people don't necessarily balance it, right? Balance it out. And it has a very different kind of structure because they can kind of, in essence, pay themselves. Right. And they can make more money to pay themselves. I don't, you know, we don't all have like a goose laying golden eggs in the back of our house where it's just like, oh, I've got more money, I'm just going to pay myself more. So, but, you know, we are also at record levels of deficit. So, you know, how long can you do that? And it's a good question, Steve. I don't have an answer for you other than, yeah, I share that question. You know, I think it's something
you got
that
a good point, because all they need to do is they print more money.
Yeah, exactly. Camellia, is that how I pronounce your name? Camellia?
Yes, it's correct.
Oh, good. So how does work from home affect commercial real estate? I think the effects we don't know yet. Right. Office is one where I think there's a lot of volatility in that market and potential volatility, given that people don't necessarily know. If you are looking at commercial real estate, you know, office investments, the big thing that I would recommend doing is looking very clearly at the leases and looking very clearly at the types of tenants, because some firms, people are there. Right. You know, I was at a function, and of course it was all these real estate people. I was at an Urban Land Institute function, and, you know, all the folks at JLL and all these, they're like, we're all there, you know, because for most brokers and for most of us, we got to be with people to get the deals done, and we're interacting, we're kicking the tires, we're going to see the buildings like we used to, we're working with other brokers. But in other environments, people are not going into the office, and who knows when they will be going in, if ever, right? So that would be something I would pay a lot of attention to as you walk around the spaces, as you look at the types of tenants that are there, and really consider it on an asset by asset basis for sure. You know, the big tech firms, I'm still amazed, but they're making huge deals and huge buys out in Culver City and on the West Side. I'm sure you guys have seen that in a bunch of the commercial real estate reports, but still nobody's in those offices. I was just at Ivy Station, you know, HBO Max is there and it's gorgeous, but they don't have people in the offices just yet, but they're still all making plays. Apple just made a big play across the street from there. So, you know, I think that's still a to be determined, but I think if you are looking at that particular segment of real estate, I don't think it could provide some really interesting opportunities, because when everybody's running one way, the way to make money obviously is to look the other way, but I would do it on a very much an asset by asset basis, and really looking at those tenants and you know, how they're using the space. We're getting into affordable housing. So, David, you asked about how do we create more affordable housing? And do I think that the change is going to help? Is that David? I think, is he on mute maybe?
David, are you able to talk? Do one, right?
Okay, I'm able to talk.
Yeah.
I recommend that R1 zoning be changed to R4 zoning and bring about a return to accelerated depreciation. That would create such an economic incentive to real estate developers that you would see a lot of single family homes being knocked down and small apartment units being brought in to change what we call a one-level environment to a multi-level residential environment. I'm asking Marilyn Bourne if she likes that idea.
Yeah, that's why I was asking for some clarification on the question clarification. Do I like that idea? It's something I'd want to really reflect on a lot more. I see people shaking their heads like, no, don't. I think, here, I'll stop my share and then we can all kind of see each other better. I haven't looked at it enough to really have an opinion about that per se. I think I'd want to study that quite a bit more. I think there's other ways to create more affordable housing, but I definitely am, much more of a pro market for sure. I'm not a big supporter of rent control and some of those things. I think the biggest issue that we face right now is a supply situation, and so your point is well taken. But I also think that, neighborhoods really depend on single family homes as well. So how's that for a good dodge? And
That's good. I want to
my future as a politician. Hey, if, Ken, you had a question?
Thank you for coming, Marilyn.
Oh, my pleasure.
Yes, Professor Bourne, I appreciate you spending the time with us today. And thank you, Peter, for inviting me. As some of these folks here know, I'm actually on the real estate development side. And I just had a question. I understand the general outlook as far as how real estate may perform as it relates to inflation and what's happening with interest rates. But on the construction cost side, I'm sitting here looking at the construction cost index for California, and since 2010, it hasn't exceeded 4% year to year until obviously this past year, which is 13.4%. And as far as rents and NOI continuing to trend upward, I don't think it's trending at the same pace, obviously, as the construction cost index. And we've been getting hit with change orders on a couple of our projects. And I'm just curious, as far as outlook for the coming year, and there's so many factors. We saw the perfect storm with obviously lumber, but still right now, steel prices are fluctuating at volatile levels, as well as lumber and some other materials as well. But I'm curious if there's anything that helps me at least have some type of forecast or outlook to understand where this is trending so that we can time the market appropriately. Otherwise, we're going to see a reduction in terms of new construction. Obviously, this is a very difficult time.
That was going to be my statement. Yeah, I think the bottom line is, we know that real estate development's kind of that on-off switch of supply, right? So if we are looking to alleviate some of the rent pressure with increased supply, rents will have to keep pace or go up even more in order to keep you having those return on costs that you need to make it profitable. Particularly if, to Peter's point, we see that, cap rates start to bump up to account for increased interest rates, right? Then those rents would have to really be storming ahead. I think they are in some sectors, for instance, industrial, right? And industrial tends to have not quite the same construction cost. That, the buildings are generally speaking a little less expensive to build than obviously residential, office, other types of products. But now, I had in my slide deck a picture of a 5-story industrial building that's being built in Ontario. So that's going to have a lot of those same cost per square foot markers of office or some of the other things. So, I think that in product types where there's just fundamentally drivers for income growth, like, as I said, the apartments and the industrial side, you may still see that ability to maintain some returns on cost, particularly if somebody bought the land before all the craziness. But yeah, I mean, we're going to start seeing some more constraints on that. And that just makes it more barriers to entry and makes it actually better to buy existing property in some ways, right?
Right.
Because it just makes that new development that much harder, at least in our market. Places like Texas and other spots aren't having the same challenges that we are. So, yeah.
Thank you.
Okay, is any more question from Professor Buon?
Yeah, I think I just have one comment on your last slide.
Yeah, actually, Peter.
This is Steve. I'm surprised to learn about the return of investment during this kind of recession. And I know the office sector is the worst sector among all the commercials, but I noticed the return is higher, but and the industrial is lower. I am a little bit surprised on that. And is there any way you can go back to last slide and please let me know why?
This slide, is that what you're talking about?
You have
So
to share
this
the
was,
screen.
oh, sorry. If it's that last slide, that particular study was done over
Yes.
a very, very long period of time. So that was looking from 1978 to 2021.
I see.
Yeah.
So right now, property changed.
Yeah. So, I mean, as we know right now, industrial, really apartments been doing the best, but industrial shortly thereafter. And so things have kind of flipped. Trying to see if
No, I think
have one
industrial is
that's
better than multi-units.
different product types. So here's one that shows, this is looking at returns, and you can kind of see here, office has definitely been eclipsed by the industrial and by the apartments. Retail used to actually be stronger. It's gotten worse. So this is looking at an index from NCREIF, but this is looking all the way from 1979 to 2021. So, but if you were to blend all of those rates together, you would see office actually, was pretty good in relative terms. But this is also looking at returns from a kind of, how they, there we go. Oh, this one, how they respond to changes in kind of inflation. Those those properties. So it's not a pure, like, this was the return. This is all kind of looking in relative to their reactions to inflation. Yeah.
Okay, got it. Thank you very much.
Okay, I think we passed the hour already, and if there's no question, I would like to thank
David, can I ask a question or make a
Alex,
quick
last
comment?
question,
Yes.
okay?
Yeah, last one, yes. I hear Ms. Marilyn talking about the injection of the money the federal government is doing it to hold the economy and everything. My concern is, what if they stop injecting the money? Are we having a strong economy, or we just on a balloon like 10, 12 years ago, what happened when the economy, the prices on real estate collapse or everything like that? I don't know if you follow me.
Yeah, so I think, I mean, I hate to sound like a broken record, but I think that basically I would go back to the structure of rents, right? So, rental income is the key here. And as long as rents are going up or holding strong, then we should be able to see some decent strength. Also, the fact that there's not a huge amount of debt I think is really positive as well. Because, as we said, if interest rates were to go up a little bit, you still have some cushion. Your returns as an investor might be slightly lower. The equity return will shrink down a bit. But generally speaking, the returns would be good. But yeah, I don't think anyone can really say right now, is there kind of this balloon or not? I would say that for the most part, it's still relatively small amounts compared to people's regular wages and regular income. It's kind of, they got this boost. It's working its way through the system, but that's not what's driving increases in rents. That's not what's driving increases in rents in terms of, for instance, industrial properties. You see a blip in terms of people buying a lot of stuff right now, but a big part of it is the shift from buying in stores to buying online, right? Same thing with, apartments. We were seeing increases in housing purchases, increasing in rent, apartments before we were going into COVID because of the large rises in household formation. In terms of the millennial population, Gen Z, et cetera, a lot of single households are being formed right now as well. So those things really are kind of underpinning a lot of the growth that you're seeing in the apartment side, the residential market, and as I said, the industrial side. I think there's structural issues, as we brought up before, in terms of office that, again, don't really have to do with like a bubble of cash that's working its way through in terms of, stimulus dollars. It's really about, are people going to be going to the office or not, right? And do office users need to shrink their space down? So I try to keep in mind what the big kind of underpinning changes are from a demographic, economic, the way we're doing business perspective. Because I think that the other aspects of it, the $1,000 people got here and there, is not going to be it's creating a little bit of a bubble, but that's not what's going to kind of unhinge things. We got bigger fish to fry, deficit being one of them, as we mentioned. So,
Okay.
Thank you.
Okay. All right. Well, at this point, I would like to thank Professor Bourne to come in to give us insights on the interest rate and the economy on the commercial real estate. I'm sure that there's a lot of uncertainty and a lot of unanswered questions, but that's what it is. We
That's
just
where we
have to
are.
wait and see, right? But we surely enjoy your presentation today, Professor. And I hope to see you again in the near future. Sometime you come back and talk to us again.
Great.
Appreciate
Thank you
that
so
very
much
much.
for having me. I appreciate it. Good luck to all of you in the new year. I think I'm
Okay.
still allowed to say that's February.
Thank you.
All right. See you guys. See you next
Bye.
month, third Wednesday of the month at 11 o'clock. Bye-bye.